So, what happens when a stock that's absolutely on fire, a real market darling that everyone's buzzing about, just hits a brick wall? Well, today, we're going to dissect the anatomy of a pretty spectacular crash, the story of Celsius.
Minus 70%. Just let that sink in. This wasn't just a bad quarter, this was a complete and total collapse in market confidence. And that leads to the big question. Yeah, how does a company that seemed to have everything going for it, a super hot brand, explosive growth, a massive distribution deal, how does it end up like this? That is exactly what we are going to break down right now.
All right, first things first. To really get why it fell so hard, you have to understand just how high it flew. See, Celsius wasn't just another company. It was a full-blown phenomenon in the beverage world.
So their whole thing was this functional energy drink. It was perfectly aimed at today's health-conscious crowd. They used a ton of influencer marketing, built this whole wellness-focused brand, and it worked. For a while, it worked spectacularly well. Okay, look at the timeline here, because the speed of all this is just wild. From 2019 to 2023, you see this insane growth. Revenue just explodes from about $57 million to over $1.3 billion. That's just wow. But then you start to see the cracks. Mid-2024, they miss on revenue, their warnings about inventory. By the third quarter, a shocking 30% drop in revenue. And then, bam, the final plunge after a really confusing investor call. It all just came apart so fast.
So, the question is, what really broke the hype? What were these specific things that went wrong under the hood that caused this massive collapse in confidence?
And this chart, this really gets to the heart of a major issue, overdependence. That huge distribution deal with PepsiCo, it was awesome for getting their cans on every shelf, but it also meant that a massive chunk of their revenue, we're talking like 62%, was completely tied to the whims of one single partner.
And there's the catch, right? What happens when your biggest partner decides to slow down their orders? Well, your whole growth engine just grinds to a halt. And that's pretty much what happened. PepsiCo reportedly pumped the brakes, and it slammed Celsius's sales, showing just how fragile that whole setup really was.
This table really lays it all out. Just look at the difference between that peak in 2023 and what happened in late 2024. Net revenue actually dropped by 4%, but at the exact same time, their expenses, for things like marketing, staff, all the overhead, shot up by 73%. That's a nightmare scenario. Revenue goes down, costs go way up. For a growth stock, that's just a toxic mix.
And if that wasn't bad enough, shareholder complaints started popping up. This quote here gets at a really serious allegation, that some of that amazing growth wasn't what it seemed. The claim was that PepsiCo was making these huge one-time bulk purchases, basically channel stuffing. Sure, it makes the sales numbers for one quarter look fantastic, but it's not real sustainable demand from people actually drinking this stuff. You're just borrowing sales from the future.
And really, that's the core of it, isn't it? The stock was priced for absolute perfection. The market was betting on flawless, unstoppable growth, forever. So the second reality set in, with all the partner problems, the slowing sales, and these questions about where the growth was even coming from, well, the stock had a very, very long way to fall. Look, the Celsius story is fascinating on its own, for sure. But the real value here is learning to spot the patterns. Because this isn't just about one company. It's about a type of risk that you see over and over again with these super hyped growth stocks. So let's compare the hype versus the reality, right? The story they were selling was so compelling. You heard things like unstoppable growth and the hottest brand out there. But when you peeled back a layer, the reality was a bit different. That unstoppable growth was actually super dependent on one partner's orders. That hot brand was fighting in a crazy competitive market. And those record sales? Well, they might have been pumped up by one-off bulk buys, not real steady demand. So what are the red flags we can take away from this? First, and this is a classic, being way too reliant on one big partner or customer. Second, a crazy high valuation that basically leaves zero room for error. Then there's the story itself. If a narrative just feels a little too good to be true, it might be. Add in growth that's coming from one-time events, not a real trend, and a general lack of clarity on where the sales are coming from, and you've got the recipe for a potential disaster. Okay, now for what I think is the most important part. Let's actually turn these lessons into something you can use. Think of this as a simple checklist to kind of stress test the next hot growth stock that everyone's talking about. So here it is, the 4-point hype check. Number 1, check for dependency. Does one partner make up, say, more than half their revenue? Number 2, check the valuation. Is the price basically assuming everything will go perfectly, forever? 3,
Check the quality of the growth. Is it sustainable, or is it just driven by these one-off boosts? And finally, number 4, check the narrative. Listen really carefully for buzzwords like timing delays or inventory adjustments. A lot of the time, that's just code for bigger problems.
And just to be super clear here, the point of all this isn't to scare you away from growth stocks. Not at all. It's about going in with your eyes wide open. It's about understanding the risks that are baked into these amazing stories, so you can just be a smarter, more prepared analyst.
So I'll leave you with this one last question to think about. Growth stories sell stocks. They are incredibly powerful, but you have to ask yourself, are you buying the story or are you buying the business? Because figuring out the answer to that question can make all the difference in the world.